In 2006, I made a decision that my partners questioned, that our investors criticized, and that made us look foolish for 18 months. We sat on $4.2 billion in cash while every other distressed debt firm was deploying capital at record speed. Private equity firms were buying companies at 14 times EBITDA. Leverage was cheap and abundant. Returns were spectacular, at least on paper. And there we were at Oaktree, watching from the sidelines, earning essentially nothing on billions of dollars. I was 59 years old. I'd been in this business for 3 decades. I knew what I was supposed to do: deploy capital, generate returns, justify our fees. But something felt wrong. The pendulum had swung too far. Prices were too high. Risk was being ignored. Everyone was extrapolating the good times forward indefinitely. So we waited, and waited, and looked increasingly out of touch. Then 2008 happened. Within 6 months, we deployed that entire $4.2 billion at prices 30 to 50% below what we would have paid in 2006. Those investments became some of the best in Oaktree's history. That decision to wait, to look foolish, to resist the pressure, was driven by one principle I'd learned 20 years earlier. Let me tell you what it was. Because if you're over 60, this principle isn't just important. It's the difference between a comfortable retirement and a catastrophic one. That principle is pendulum awareness, understanding where we are in the market cycle and positioning accordingly, not predicting where we're going, but recognizing where we are right now. This matters more at 60 than at any other age in your life, not because the principle changes, but because your margin for error has disappeared. At 30, you can recover from a 50% loss. You have 3 decades of earnings ahead. At 60, a 50% loss might be permanent. You don't have time to wait for the next cycle. You don't have future earnings to replenish what's lost. You have what you have, and your job is to keep it. Before I go further, I need to know who I'm talking to. Drop your age and what percentage of your portfolio is in stocks right now. Just those 2 numbers. I'm genuinely curious because what I'm about to share will hit differently depending on where you stand. And if you're serious about protecting what you've spent 40 years building, subscribe now. This channel isn't about chasing returns or finding the next hot stock. It's about second-level thinking, the kind that's preserved wealth through 8 market cycles and counting. The kind that kept us from losing everything in 2000, in 2008, and in every other crisis that destroyed people who thought they were being smart. Now here's what I'm going to show you in the next 12 minutes, where we are in the current market cycle and what that means for your money. The specific pendulum strategy that doubles your safety after 60, and the exact allocation framework that's protected wealth through every crisis I've witnessed. But you need to stay until the end, because the most important piece, the one that determines whether this actually works for you, comes in the final 3 minutes. Let me start with what most people get wrong about investing after 60. They think it's about growth versus safety, stocks versus bonds, risk versus security. They've been taught the 60-40 portfolio, the 4% withdrawal rule, the glide path to retirement. Every financial advisor has the same PowerPoint. Every retirement book has the same charts. But here's what 5 decades of watching markets actually shows. It's not about your age-based allocation. It's about your cycle-based positioning. The difference between these 2 approaches is the difference between losing 30% of your wealth when you can't afford to lose it and sleeping soundly through the chaos. This isn't opinion. This is pattern recognition across 8 complete market cycles, 4 major crashes, and hundreds of investors I've watched either preserve their wealth or destroy it. And it all comes down to pendulum awareness, not asset allocation formulas, but cycle positioning. Not diversification percentages, but understanding where we stand right now. I'm going to break this down into 5 specific positions you need to understand. Each one corresponds to where the pendulum is in its swing. Miss one, and you'll be positioned for the last crisis instead of the next one. Master all 5, and you'll know exactly what to do regardless of what the market does tomorrow. Let's start with the position that most people over 60 are dangerously wrong about right now. The first position you need to understand is recognizing where the pendulum actually is. Not where you hope it is, not where the financial media says it is, but where the evidence points. This is the foundation. Without this, everything else fails. Here's what most people do. They look at their account balance, see it's higher than last year, and assume things are fine. They watch CNBC and hear about economic growth. They read headlines about corporate earnings. It all feels positive, so they stay fully invested. They believe the good times will continue because the good times are happening right now. But this is exactly backwards. The best time to be defensive is when everything feels great. The time to worry is when nobody's worried. I see this constantly in investors over 60. They've got 70% in stocks because stocks have done well. They're extrapolating recent performance into the future. Every time markets reach new highs, they get more confident instead of more cautious, and every time they're shocked when the inevitable reversal comes. Let me show you this principle in action. In 2005, I started getting nervous. The distressed debt market, which I'd been investing in for 2 decades, was showing troubling signs. Default rates were at historic lows, under 2%. Credit spreads had compressed to levels I'd never seen. Companies with terrible balance sheets were borrowing money at rates that didn't reflect their risk. Everyone was chasing yield. Leverage was everywhere. The consensus was that we'd entered a new era of stability. The Great Moderation, they called it. Risk had been tamed through better monetary policy and financial innovation. I didn't believe it, not because I'm smarter, but because I'd seen this movie before. In the late 1980s, before the S&L crisis, in the late 1990s, before the dot-com crash, every time the pendulum swings to extreme optimism, every time risk is ignored, every time people say this time is different, the setup is the same. So in 2005, we started raising cash. By 2007, we were sitting on over $4 billion, earning basically nothing. Our investors questioned this decision. Some left for firms that were fully deployed and showing better short-term returns. It was uncomfortable. It looked wrong. But we understood where we were in the cycle. We recognized the pendulum position, then 2008 happened. Credit markets froze, default rates shot from 2% to over 10%. Companies that had borrowed freely couldn't refinance. The same assets we'd passed on at 70 cents on the dollar became available at 30 cents. We deployed that $4.2 billion in 6 months. Those investments returned 25 to 30% annually over the next 5 years. This wasn't luck. This was pendulum awareness working exactly as it always does when you recognize extreme positioning. At Oaktree, we use a simple framework for this. We don't predict where the pendulum will go. We observe where it is right now. We look at credit spreads, equity valuations, investor sentiment, capital availability, and deal terms. When these indicators show extreme optimism, we get defensive. When they show extreme pessimism, we get aggressive. The key insight is this. First-level thinking says the trend will continue. Second-level thinking asks what happens when the trend reverses. And when you ask that question, you realize that extreme positions are temporary by definition. The pendulum always swings back. Always. The question isn't whether it will reverse. The question is whether you'll be positioned correctly when it does. So, what do you actually do? You need to assess 3 specific indicators every quarter. First, look at the Shiller P/E ratio. When it's above 25, stocks are expensive by historical standards. Above 30, they're in bubble territory. Second, check the VIX index. When it's below 15 for extended periods, complacency is extreme. Third, observe what regular people around you are doing. When your neighbors are day trading, when Uber drivers are giving stock tips, when everyone feels like a genius, the pendulum is at an extreme. Right now, as I'm recording this, the Shiller P/E is above 31. The VIX has been suppressed. Retail investor participation is at record levels. These aren't predictions, they're observations, and they tell you where the pendulum is positioned. If you're over 60 with 70% in stocks right now, you're betting that extreme optimism will become more extreme. That's possible, but it's not probable. And at your age, you can't afford to bet on improbable outcomes. The evidence for this principle is overwhelming. Every major market decline in the past 50 years was preceded by extreme optimism. The 1987 crash came after 5 years of gains. The 2000 tech crash came after the greatest bull market in history. The 2008 crisis came after years of rising home prices and easy credit. The pattern is always the same. Optimism breeds complacency. Complacency breeds risk-taking. Risk-taking breeds fragility. And fragility eventually breaks. This isn't cynicism, it's cycle awareness. The good times contain the seeds of the bad times. The bad times contain the seeds of the good times. Understanding this, truly internalizing it, changes everything about how you invest after 60. This leads to an important question. If you know where the pendulum is, what do you actually do about it? Which brings us to the second position you need to understand. Early cycle positioning is when you should be most aggressive. This is when the pendulum has swung to extreme pessimism. when everyone is terrified, when the financial media is predicting disaster, when your friends are selling everything. This is counterintuitive. It feels dangerous, but it's actually the safest time to take risk because risk has been priced in. Here's what most people do. They wait for things to feel better before investing. They want confirmation that the crisis is over. They need to see positive headlines. So they wait through the bottom, wait through the early recovery, and finally invest when they feel comfortable, which is exactly when they should be getting cautious. I see this pattern repeatedly with investors over 60. They sold in panic during 2008 and didn't reinvest until 2013 when they finally felt safe. They missed the entire recovery. They locked in their losses and missed the gains, the exact opposite of what they should have done. Let me show you this principle in action. In March 2009, I wrote a memo titled, "The Tide Goes Out." The S&P 500 had fallen 57% from its peak. Everyone was predicting depression. Unemployment was rising. Banks were failing. The consensus was that stocks would go much lower. I argued the opposite, not because I knew the economy would recover quickly, but because the pendulum had swung to extreme pessimism. Risk was being overpriced. Quality companies were trading at valuations that implied bankruptcy. The margin of safety was enormous. If you were 65 in March 2009 and had the courage to invest when everyone else was selling, you captured one of the greatest bull markets in history. The S&P 500 went up over 400% in the next decade. Even if you're in your 70s now, that return transformed your retirement. But it required doing the opposite of what felt safe. It required understanding that maximum safety comes from buying when others are selling, not when you feel comfortable. At Oaktree, our most aggressive period was 2008 through 2010. We raised capital, we deployed capital, we took concentrated positions in distressed debt. Our investors were nervous. Some thought we were being reckless, but we understood the cycle position. We knew that when everyone is pessimistic, when capital is scarce, when prices reflect worst-case scenarios, that's when you should be aggressive. The results speak for themselves. Those vintage years produced our best returns, not because we're brilliant, but because we respected the pendulum. Now here's the second-level insight. First-level thinking says, don't invest when things are scary. Second-level thinking asks what's already priced in. And when you ask that question, you realize that maximum fear creates maximum opportunity. The time to be aggressive isn't when you feel brave. It's when everyone else is terrified and you understand that their fear has created value. So what do you actually do when the pendulum swings to extreme pessimism, when the Shiller PE drops below 15, when the VIX spikes above 40, when your friends are predicting the end of capitalism? That's your signal. If you're 65 with a conservative allocation, this is when you increase your equity exposure. Not to 80%, but maybe from 40% to 55%. If you're 70, maybe from 30% to 40%. The exact numbers depend on your situation, but the principle is universal. Be most aggressive when others are most fearful. This requires emotional discipline. It requires going against every instinct. But it's the only way to actually buy low and sell high instead of just talking about it. But early cycle positioning alone isn't enough, because cycles don't announce themselves, which brings us to the third position. Mid-cycle positioning is when you should be balanced. This is the longest phase of most cycles. Things are neither euphoric nor terrifying. Markets are grinding higher. The economy is growing. Nothing feels extreme. This is when most people relax. They think the hard decisions are behind them. They set their allocation and forget about it. But this is actually when you need to be most vigilant. Here's what most people do. They assume mid-cycle will last forever. They extrapolate steady growth indefinitely. They stop monitoring the pendulum position. So they drift from balanced to aggressive without realizing it. Their stocks appreciate, their allocation shifts, and suddenly they're more exposed than they intended to be. Then when the cycle turns, they're caught off guard. I see this constantly with investors over 60. They started retirement with a 60-40 allocation. Stocks went up. Now they're 70-30 or even 80-20, but they haven't rebalanced. They've let the market dictate their positioning instead of maintaining their strategy. In 2015, I watched a 72-year-old couple make this exact mistake. They'd retired in 2010 with $1.8 million, allocated 60% stocks and 40% bonds. By 2015, their portfolio had grown to $2.4 million, but it was now 72% stocks because equities had outperformed. They felt wealthy. They didn't want to sell winners and lock in gains. I told them they needed to rebalance back to 60-40. They didn't listen. When 2022 came and stocks fell 25%, they lost over $400,000. If they'd rebalanced in 2015, maintained their discipline, stayed balanced through mid-cycle, they would have lost $150,000 less. That difference at their age was devastating, not because $400,000 destroyed them, but because they couldn't recover it. They're 79 now. That money is gone forever. At Oaktree, we're constantly monitoring our positioning relative to the cycle. When we're in mid-cycle, we maintain balance. We don't chase returns. We don't get greedy. We stick to our strategy. This sounds simple, but it's actually the hardest phase psychologically because nothing bad is happening. Everything feels fine. The temptation to relax is enormous. But mid-cycle is when you maintain discipline, so you're prepared for late cycle. Now here's the second level insight. First level thinking says, enjoy the good times. Second level thinking asks how long the good times can last. And when you ask that question, you realize that mid-cycle is preparation time. You're not trying to maximize returns. You're trying to maintain positioning so you're ready when the cycle inevitably turns. So what do you actually do? Every 6 months, rebalance back to your target allocation. If you started at 60% stocks and you're now at 68%, sell 8% and buy bonds. If you're at 52%, do nothing. The point is maintaining your strategy regardless of how you feel. Set a calendar reminder. Make it automatic. Remove emotion from the decision. This is boring. This is unglamorous. But boring and unglamorous is what preserves wealth after 60. Excitement is for people who have time to recover from mistakes. You don't have that luxury anymore. This principle has saved me repeatedly. In 2017, when markets were strong and everyone was optimistic, we stayed balanced. We didn't chase late cycle opportunities. We maintained our discipline. When 2020 came and COVID crashed markets, we were positioned to act. We had dry powder. We could be opportunistic. That preparation during mid-cycle enabled aggressive action during the crisis. This is how the pendulum strategy actually works. You position for the current phase while preparing for the next phase. You never get caught off guard because you're always aware of where you stand. The specifics matter here. Mid-cycle positioning means monitoring your allocation quarterly and rebalancing semi-annually. It means resisting the temptation to chase performance. It means accepting average returns during the long periods between extremes. Most investors can't do this. They get bored. They want action. They want to feel like they're doing something. But at 60 plus, doing nothing is often the smartest move. Maintaining your strategy through mid-cycle is what enables you to be aggressive in early cycle and defensive in late cycle. Skip this step, and the whole system falls apart. This is where conventional wisdom fails. Every retirement book tells you to set your allocation based on your age and forget about it. But that ignores the cycle. It treats all market environments as equivalent. They're not. Being 60% in stocks at a Shiller PE of 15 is completely different from being 60% in stocks at a Shiller PE of 35. The cycle position matters more than the allocation formula. Understanding this, truly internalizing it, is what separates people who preserve wealth from people who lose it when they can't afford to. Now I'm going to show you something that will surprise you. The most dangerous position isn't early cycle when everything looks terrible. It's late cycle when everything looks great. Which brings us to the fourth position. Late cycle positioning is when you should be most defensive. This is when the pendulum has swung toward optimism. Not extreme yet, but clearly elevated. Valuations are high, sentiment is positive, everyone's making money. This feels like the time to stay invested. But it's actually when you need to start protecting what you've built. Here's what most people do. They see their portfolio reaching new highs, and they relax. They think they've figured it out. They feel like geniuses. So they stay fully invested or even add more risk. After all, why get defensive when everything's working? I see this constantly with investors over 60. They reach their retirement goal, maybe even exceed it, and they don't protect it. They keep playing the same game even though they've already won. They risk what they have and need for what they don't have and don't need. It's irrational, but it's human nature, and it's destroyed more retirement plans than any market crash. Let me show you this principle in action. In 2021, I started getting defensive. Not panicked, not predicting disaster, just cautious. The S&P 500 was up over 25%. SPACs were everywhere. Crypto was at all-time highs. Retail investors were piling in. Everything felt a bit too good. The pendulum was swinging toward late cycle. So I recommended that investors over 60 start reducing equity exposure. Not selling everything, but trimming from 60% to 50% or from 50% to 40%, taking some chips off the table. Many didn't listen. They'd made money in 2020, made more in 2021, and they wanted to keep riding it. Then 2022 happened. Stocks fell 25%. Bonds fell 13%. It was the worst year for balanced portfolios in decades. The investors who'd gotten defensive in 2021 lost less. The investors who'd stayed aggressive lost more. At 65 or 70, that difference matters enormously. At Oaktree, we started raising cash in 2021. We slowed our deployment. We became more selective. We passed on deals that would have looked great 12 months earlier. Our investors asked why we were being so cautious when markets were strong. I said the same thing I always say. The best time to be defensive is when you don't need to be. The worst time to be defensive is when you have to be. By the time everyone knows it's late cycle, it's too late. The damage is already done. Now here's the second level insight. First level thinking says stay invested when things are good. Second level thinking asks what good times lead to. And when you ask that question, you realize that prolonged good times lead to complacency, excessive risk-taking, and eventual reversal. Late cycle isn't the time to maximize returns. It's the time to lock in gains and prepare for the inevitable turn. So, what do you actually do? When the Shiller PE exceeds 28, when the VIX stays below 15 for months, when everyone around you is confident, start reducing equity exposure. If you're 65 at 60% stocks, move to 50%. If you're 70 at 50% stocks, move to 40%. Do this gradually over 6 to 12 months. You're not trying to time the top. You're trying to reduce your exposure before the pendulum swings back. This might cost you some upside if markets continue higher, but at your age, missing upside is acceptable. Taking a major loss is not. The asymmetry is clear. Protecting what you have matters more than maximizing what you might get. The final piece of this puzzle is crisis positioning. This is when the pendulum has swung to extreme pessimism, when markets have crashed, when your portfolio is down 30 or 40%, when everyone is predicting disaster. This is paradoxically when you should be most calm and most opportunistic. Here's what most people do. They panic, they sell, they lock in losses, they swear they'll never invest again. Their emotional response is exactly wrong at exactly the wrong time. I see this with investors over 60 more than any other group. They can't psychologically handle seeing their life savings decline by hundreds of thousands of dollars. So they sell at the bottom and move to cash. They feel safer, but they've just guaranteed their losses and eliminated their ability to recover. In March 2020, when COVID crashed markets, I received dozens of calls from investors in their 60s and 70s. They were terrified. They wanted to sell everything. I told every single one of them the same thing: do nothing. If you're already properly positioned, if you followed the pendulum strategy and were defensive going into the crisis, then you've already protected yourself. Your equity exposure is appropriate. Selling now locks in losses. Staying invested gives you the recovery. The investors who listened preserved their wealth. The investors who sold destroyed theirs. The S&P 500 recovered fully within 5 months and went on to new highs. The people who sold in March missed the entire recovery. At 70, you don't get another chance. At Oaktree, crisis positioning means being opportunistic. When everyone else is selling, we're buying. When capital is scarce, we're deploying. When prices reflect panic, we're taking advantage. But here's the key. We can only do this because we were defensive before the crisis. We had dry powder, we had capacity, we were prepared. If we'd been fully invested at the top, we couldn't be aggressive at the bottom. The crisis positioning works because of the late cycle positioning that preceded it. They're connected. You can't do one without the other. Now here's what concerns me. I'm seeing the same patterns right now that I've seen before. Every major reversal, extreme valuations, suppressed volatility, widespread optimism, retail investor participation at record levels. I'm not predicting a crash, I don't predict, but I am preparing for one. And if you've understood these 5 positions, you should be too. Because here's the ultimate insight. The pendulum always swings. Always. It swings from pessimism to optimism and back again. From fear to greed and back to fear. Understanding this, positioning for this, respecting this is what separates successful investors from everyone else. Not intelligence, not information, pendulum awareness. So how do you actually implement this? Let me give you the specific framework we use at Oaktree, adapted for individual investors over 60. Before every allocation decision, ask yourself these 5 questions. Where are we in the cycle based on valuations, sentiment, and volatility? What is my current equity exposure compared to my target? Am I positioned appropriately for the current cycle phase? What would happen to my portfolio if markets fell 30% tomorrow? Can I sleep at night with my current allocation? If you can't answer yes to at least 4 of these questions, you need to adjust. And here's what you need to do in the next 30 days. Calculate your current allocation. Compare it to where you should be based on cycle position. If you're overexposed given current valuations, reduce equity by 5 to 10%. Set a calendar reminder to review quarterly. Track the Shiller PE, VIX, and your own emotional state as indicators. This isn't sexy. This isn't exciting, but it works. And working is better than exciting when you're protecting 40 years of savings. That decision in 2006 to sit on cash while everyone else was deploying. That's where we started. Now you understand why I made it. It wasn't about predicting the future. It was about recognizing the present. The pendulum had swung too far. Risk was being ignored. Prices didn't reflect reality. So we positioned defensively even though it looked wrong. Even though we were criticized. Even though we gave up short-term returns. Because we understood something that most investors never learn. The pendulum always swings back. Always. And when it does, positioning matters more than prediction. You now know what took me 50 years to learn. You understand the 5 cycle positions. You have the framework. The question is, will you use it? Because here's the reality. Most people won't. They'll watch this, nod along, and change nothing. They'll keep their current allocation. They'll ignore the cycle. They'll hope for the best. And when the pendulum swings, they'll be caught off guard like everyone else. Don't be most people. Before you go to bed tonight, calculate your current equity percentage. Write it down. Compare it to where you should be based on everything I've told you. If you're overexposed, commit to reducing by 5% this month. That's your first step. And subscribe if you haven't already. Because this is about second-level thinking. This is about cycle awareness. This is about protecting what you've spent a lifetime building. The pendulum will swing. The only question is whether you'll be positioned correctly when it does. 50 years of investing teaches you one thing above all else. Respect the cycle. That's what surviving 8 crises shows you. That's what building Oaktree proves. Pendulum awareness isn't just a strategy. It's the strategy. The only one that works across all market environments. I can't implement it for you. I can only show you how. The rest is up to you.